Hi friends, this is part 2 of my video which is where to invest 1 lakh rupees right now. Thank you so much for your overwhelming response in part 1. Therefore, I'm creating part 2 for you. As you can see on my screen, in part 1 we learnt about 4 types of investors and 3 types of time horizons deciding where to put this 1 lakh rupees exactly, and we learned about 3 cases: case number 1, case number 2 and case number 3. Now in this video I want to talk about case number 4, 5 and 6, which is all about if you are a balanced investor. Before I move further, let me make one point very clear, that if you want to be financially independent and retire early, FIRE, then your first goal should not be investing. It should actually be reducing your financial risk. And at present, one of the biggest financial risk all of us carry is the medical expenses. Why? Because in India, medical expenses are growing at a significant rate. One single medical bill can leave a big dent in our investment and savings. So having health insurance is a fail-safe bet that all of us must rally behind. And if you do not have health insurance yet, you can call experts at Ditto Insurance. Ditto is an insurance platform backed by Zerodha and will give you free consultation to select the right health insurance policy for you. Ditto Insurance, being a 100% spam-free platform, gives you complete peace of mind. Simply click on the link in the description below and go to their website. Click on the book a call and select health insurance. You can then select the date and time that suits you the most. Provide your details, sit back and relax. Ditto's team will call you and discuss your personal needs when it comes to health insurance. Let me now walk you through case number 4, which is if you are a balanced investor and if you are willing to hold this 1 lakh rupee for more than 3 years of time horizon. Who is a balanced investor? Let's also understand that. So a balanced investor is an investor who is willing to take risks of up to 20% losses in their portfolio, and also they are expecting more returns than the conservative investor. So they would want to see their portfolio growing by up to 20%. So they are happy to go down by 20%, up to 20%, minus 10%, minus 15%, minus 20%, as well as they would like their returns to go up to 20%, like 15%, 18%, 20% returns. And because they are willing to take higher risk, they would expect higher returns from their portfolio. So for case number 4, the allocation that makes more sense from a data perspective that I'm going to show you right now is that you can consider investing 80% of that 1 lakh rupees in blue chip stocks, selected blue chip stocks, and 20% of your money in selected mid cap stocks. Why so? Let me run you through the best case scenario, the worst case scenario, and the average case scenario from a returns perspective. So from a best case scenario perspective, your 80,000 rupees here can generate maximum up to 35% returns annually. And from a mid cap stocks perspective, 20,000 rupees can generate close to 103% returns annually for you, giving you best case scenario of average returns 49%. Again, it's a huge returns, but let me now give you some data points to see that whether any stocks have given such returns. So if I show it to you, the blue chip stocks, so let us see, I have selected 50 stocks here, and if you look at the 5-year CAGR, you see that Adani has given 75%. Again, exceptional situation. I'm going to keep it to one side. But you see likes of Apollo Hospitals, Titan, they have given close to 35% returns. So if I assume 35% return on this 80,000 portfolio, you are going to get 28,000 rupees per annum as returns on this portfolio. While if you look at the mid cap stocks, so again I have selected 150 mid cap stocks here. Let's look at the 5-year CAGR, and you will see likes of Lloyds Metals and Energy Limited has given close to 103% annual returns. And if you put this number here as the best case scenario, you are going to come to average returns of 49%. Again, this is huge return. It is possible, but please understand the probability of hitting 49% annual returns is extremely low. That's why I call this only best case scenario. This is one side of the spectrum. But let me also show you the far end of the spectrum, which is the worst case scenario, so that we understand the risk associated with it. So from a worst case scenario perspective, if we look at and if we go to the blue chip stocks, so let us go ahead and look at the 5-year CAGR from a negative percentage perspective. You will see close to 4% annual returns for last 5 years has been given by this particular bank here. So if I go ahead and put that number here, minus 4%. From a mid-cap perspective, if you look at the last 5 years CAGR return from a negative perspective, the worst returns that has been given by Yes Bank, close to minus 43%. So if I use minus 43% number here, we see that the average worst return that we can witness is close to minus 12%. So your portfolio can go down by minus 12% annually, and this is the worst case scenario. But again, Worst case and best case scenario is just for our awareness. It is less likely to happen. It all depends on our stock picking abilities, and this will vary from individual to individual. But more importantly, let me come back to the average returns that we could expect from this sort of portfolio. So let us come back here, and you see from a blue chip stocks perspective, 15% annual returns is more reasonable, more average return, and 12% from mid cap perspective. Let me quickly show it to you. So if you look at the 5-year CAGR perspective, and if you go down to stock number 25, you will see close to more than 25 stocks have given 15% return here. Likewise, if we go to the mid cap stocks here and have a look at close to 75th stock out of the 150 stocks in mid cap category. So let us go to 675 here. You will see close to 12% return is what you can expect from a mid cap perspective. So if you put that number here, your average return is likely to be 14%. So just summarizing, case number 4, best case scenario is 49% annual returns. Worst case scenario is minus 12% annual returns, and average case return is 14%, which is better than a Nifty 50 returns. And this is where if you're a balanced investor willing to hold for more than 3 years, this allocation makes more sense. Let's move to case number 5, which is if you're a balanced investor and want to invest this 1 lakh rupee between 1 to 3 years of time horizon. Where should you put this money? So in my simple view, we can consider 50% in selected blue chip stocks, 40% in Nifty 50 index fund or ETF, and 10% in mid cap index fund. Let me now run you through best case scenario, worst case scenario, and an average or more reasonable case scenario. From a best case scenario perspective, if you have a look at my screen, blue chip stocks 50,000 rupees can give you maximum 40% annual returns if you invest it for a time horizon of 1 to 3 years. I've taken 1 year as a basis to calculate the returns. Let me quickly show you. So if you look at the top 50 stocks, we will see that in the last 1 year, maximum returns that we have got is in high 40s. So if I assume 40% returns, then let's put the 40% here. From a Nifty 50 index perspective, if I show you the data, let us go ahead and have a look at Nifty 50 data from 2003 onwards for 20 years of data. And if I consider 2 years of rolling period, I am considering 2 years here. Let us have a look at the best return. Maximum Nifty 50 has given for a 2-year rolling period basis is 64%. So if I plug 64% here, that will give us some returns. And now let us talk about Nifty mid cap 150 index. So this index, so if I show you the data, let us go ahead and have a look at Nifty mid cap 150 TRI from last 20 years or 18 years of data, 2 years rolling period basis. If you look at the maximum returns, you will see 78%, right? So let us put 78% here. That brings our average best case return to be 53%. Again, it's a very high number. It is not impossible, it is possible, but the probability of hitting 53% annual returns is very, very low. Let me now walk you through the worst case scenario as well, just so that we understand the second side of the spectrum. So from a worst case perspective, if you look at it, blue chip stocks have given minus 11%. So let us go back and have a look at last 1 year's return. Again, if I remove Adani Enterprises because it seems to be an exception, if you look at the UPL, for example, close to minus 10%, 11% returns, negative perspective is what we can understand given the current circumstances. So let us go ahead and put that minus 11% from a blue chip stocks perspective. From a Nifty 50 index perspective, if we look at the rolling returns, we will see minus 17% is the maximum loss we could expect. So that is minus 17% here. From a mid cap 150 index perspective, if you look at the data, then we will see minus 27%. So let us put minus 27% here. That brings us to minus 15% average return when it comes to the worst case scenario possible given the last year's data. And that tells me that from a worst case scenario perspective, this balanced investor is willing to lose up to 20%. So minus 15% could be a scenario that can play out from a risk perspective. Let me now walk you through the average case scenario, average returns. So from an average case perspective, let's look at the top 25 stocks. So 25 stocks, more than 25 stocks have given close to 18% return. So let us go ahead and put the 18% number. But again, please understand, right now we are in a bull run situation. Every stock is performing better. These numbers might differ depending on when you plan to invest. So I'm assuming here 18% return. From a Nifty 50 perspective, if you look at the average returns, we will see 16%. So let us put that 16% number here. From our mid cap index perspective, average returns are 16% roughly. So let us put 16% here. That brings us to the average or more reasonable returns of 17% when it comes to case number 5, which is far better than conservative investor. But please also understand the risk here we are taking is the losses could be more than what we saw in the conservative investors case. So here for case 4, let me summarize. Best case returns 53%, worst case returns minus 15%, and average case return 17%. So far, if you're liking this video, humble request to hit the like button and also let me know in the comments a simple thank you message. It will motivate me a lot to come up with more and more videos for you. Also, you can consider subscribing to my YouTube member community because I share in-depth exclusive analysis of many stocks and mutual funds so that you can understand which stocks to pick and which stocks to leave. That will give you a lot of benefits. Having said that, let's move to case number 6, which is if you're a balanced investor and want to invest 1 lakh rupees for a time horizon of less than 1 year, then what are your good chances to get good profits? So for case 6, the allocation that will make more sense is 40% in fixed deposit. Yes, we are back to fixed deposit because remember this is less than 1 year of time horizon, and 30% in Nifty 50 index fund and remaining 30% in selected blue chip stocks. Let me now walk you through the best case scenario, worst case scenario, and the average case scenario. So the best case scenario here you could expect is from a fixed deposit perspective, 7% on an average you can expect. From a Nifty 50 index perspective, if we have a look at the data here, so if we look at 1 years of rolling returns from last 20 years data, we will see that the maximum you have got is 100% return from a Nifty 50 perspective. So I'm going to use 100% here and you will see that number going up because of this huge returns from Nifty from a 1 year's perspective. But again, please understand this is only best case scenario. It may play out, it may not play out. Also, let us now look at the blue chip stocks. So if you look at last 6 months return from a blue chip perspective, for example, likes of Tata Motors has given 52% return. So let me use 50% return here as the best case scenario. Again, not a recommendation about Tata Motors. It's just the name that came up on the screen. So overall, average returns that you're going to get in the best case scenario will be 48%. Again, huge returns only happens in the best case scenario. But let us now move to the worst case scenario. What could happen from a worst case scenario perspective? So from a FD perspective, still 7% worst case scenario. From a Nifty 50 perspective, if we look at the data here, we will see the minimum that it can go down to is in a year is 55%. So let us put that 55% here. And from a blue chip stocks perspective, if you look at the data here, let us see UPL Limited in the last 6 months have gone down by close to 12% here. So let us put that 12% number here and it comes out to be average minus 17%. So your portfolio of 1 lakh rupee can go down by minus 17% if you look at investing less than 1 year. Because you are a balanced investor and you're willing to take that risk, I've used that number here minus 17%. But what are the average or reasonable returns that we could expect? Let us go ahead and have a look at that. From a FD perspective, 7% returns. From a Nifty 50 perspective, if I show you the average return, then it comes to be 18%. So let us use 18% number here. And from a blue chip stocks perspective, if you look at the data, if you go to stock number 25, we see that more than 25 stocks have given us close to 22% return. So let us use that number here, 22%. And that brings the average returns to be 15%, in the range of 15%. So in summary, case number 6 presents us best case scenario of 48% returns, worst case scenario of minus 17% return, and average case scenario of 15% returns. Also, in my part 1 video, I made a mistake. So I am going to explain to you in just 30 seconds. The mistake I made was in case 3. So what I presented to you in case 3 was that conservative investor holding less than 1 year. We looked at the data only from a monthly perspective and I put in the number as 1%, minus 37% and 30%. But actually that was only considering the 1 month rolling period. I made a mistake there, silly mistake there. Let me correct it now to say that the data you need to use is 18%, minus 55% and 100%. This will slightly change your position that your average return will be 10% now and your worst case will be minus 1% rather than 0% and your best case scenario will be 20%. All in all, the allocation that I talked about in case 3 will still work, but from a returns perspective, I made a mistake and I wanted to make sure that I clarify that and correct it. And I'm really sorry that I made a silly mistake. I just wanted to make sure that you're clear that I made a mistake in part 1 of this video. So this covers the balanced investor, but I don't know whether you would like me to create the video for aggressive investors as well. Case number 7, 8 and 9. Let me know in the comments if you would like me to create video for the aggressive investors as well. I don't know how many of you are actually aggressive investors, but I would love to know if you would like me to create part 3 of this video. So let me know in the comments. Also, a humble request: before you invest 1 lakh rupees or any money for that matter, Please make sure you have a health insurance in place. Don't shy away from calling Ditto Insurance so that your financial risk is minimized. You will find the link in the description. Lastly, you can consider joining my YouTube member community because I post in-depth exclusive analysis of stocks, mutual funds and other assets, and you might get benefited from using that information. With that, I hope you enjoyed this video. I will see you in my next video. Until then, keep rocking.